Hey there, folks! If you've been searching and looking for retirement advice online, you've probably noticed that almost every single plan and strategy is built around one specific, stubborn little number. That number is 59 and a half. It's the magic age where the IRS finally decides to let you open up your traditional retirement accounts, like your 401k or traditional IRA, without thinking and hitting you with that nasty, cold-blooded early withdrawal penalty check. But it simply isn't the only way to go about it, folks. But let's be honest here, folks. What if you don't want to keep working until you're nearly 60? What if you've worked hard, lived frugally, and you're completely ready to walk away from that corporate grind at age 55? It ain't a crazy idea. Well, that is the exact situation my good friend Richard found himself in this past winter. He was 56 years old, feeling absolutely exhausted from the daily commute and the endless meetings, and ready to start a fresh new chapter in his life. Richard had done everything right throughout his career, constant saving and planning. Over 30 years of hard work, he managed to save up a solid $750,000 inside his employer's active 401k plan, thinking he was totally set. But when he actually started looking at his options, he ran headfirst into a wall of confusing tax rules, complex regulations, and conflicting advice from different bank advisors who were constantly pushing their own products. He was under the impression that he was completely stuck waiting another 3.5 years just to touch a single dollar of his own hard-earned money to pay his monthly bills. That simply ain't a good feeling, folks. That is, until he heard about a special IRS loophole that seemed like the absolute perfect escape hatch for early retirees looking to leave the corporate world behind, leaving it all before age 59 and a half. It got him thinking. It's called the Rule of 55. And on paper, it sounds like an absolute lifesaver for folks wanting to leave their jobs early and start enjoying their life without dealing with those nasty IRS penalties. Under this specific IRS rule, if you leave your job in or after the calendar year you turn 55, you can withdraw money penalty-free from that current employer's retirement account. It's a huge deal, folks. But there is a massive catch, folks. A hidden financial trap that almost nobody in the financial industry warns you about until it's already too late, and your money gets locking away because you made a simple mistake. Richard walked straight into this trap, and it cost him his early retirement dreams. Today, I'm starting and gonna breaking down the numbers to make sure you don't make the same mistake. I'm Earl, and if you're interested in keeping the money you worked hard to save instead of giving it away, go ahead and hit that subscribe button right now. It won't cost you a dime. I put out real retirement money talking every couple days. Plain English, no hype, no fear, just the honest numbers that actually protecting your nest egg. All right, let's look at exactly what happened to Richard, and how a seemingly smart move turned into a complete financial disaster for his family's planning, because of one paper he signed. After Richard decided to leave his corporate job at 56, he went to see a local financial advisor at his neighborhood bank branch to discuss what to do with his nest egg. He was looking for guidance. The advisor smiled warmly, looked at Richard's $750,000 balance, and made a very standard, routine industry planning recommendation without thinking twice about the consequences. He said, "Richard, you need to roll that old 401k over into a traditional IRA with us. We have better investment options, more control, and much lower fees overall. It ain't a hard choice." It sounded completely reasonable to Richard. Almost every financial commercial you see on television or read in magazines tells you to do the exact same thing when you're leaving your job. So, Richard signed the papers. He authorized the direct transferring of every single dollar out of his employer's 401k plan. and directly into his brand new private bank IRA, thinking he was doing the smart thing. He went home, sat beside his desk, and felt a huge sense of relief wash over him. He truly believed his retirement was officially holding up and locked in. But he was wrong, folks. But when he tried to withdraw $25,000 a few months later to cover his basic living expenses and mortgage, he got a huge, unexpected shock. Things started falling apart. His tax software flagged the withdrawal and tacked on a brutal 10% early withdrawal penalty. That's a flat $2,500 taken straight from his hard-earned savings. 'Cause of that transfer, Richard called me, completely panicking and confusing about the whole situation. He said, "Earl, what happened? I thought the Rule of 55 protected me from this tax penalty. This simply ain't fair." I had to deliver the cold, hard, bad news to him. I said, "Richard, the Rule of 55 only applies to employer-sponsored plans. It simply isn't going to apply into private IRAs. By rolling his money out of his employer's 401k and into a private bank IRA, Richard had completely and permanently destroying his penalty-free access to that money. It ain't coming back. This is the deadly rollover trap, folks. Once that money is leaving the 401k envelope for good, the special Rule of 55 protection vanishes forever and cannot be brought back, no matter what you try. And there is absolutely no undo button. You cannot just transfer the money back next week and ask in the IRS for a friendly do-over. Once it's rolled over, it's done, 'cause it's final. Why does this happen? It all comes down to how the tax code is written under Internal Revenue Code Section 72, letter T, paragraph 2, subparagraph A, Roman numeral 5. It's all there, folks. The code specifically exempts distributions from qualified employer plans made after separating from service in or after the calendar year you reach the age of 55. Notice the exact wording of the law, folks. Qualified employer plans. That means active 401ks, 403bs, and 457bb plans, strictly excluding all personal IRAs. So when you do a rollover to an IRA, you are changing the legal structure of your retirement money in the eyes of the IRS and the tax code. Suddenly, that money is governed by the standard IRA rules, which are strictly locking everything up until you reach the age of 59 and a half, with no exceptions. It simply ain't fair. Your bank advisor won't warn you about this, 'cause they're looking to get your assets under their management to collect their monthly fees and commissions, folks. But the traps don't stop there, folks. Let's look at the second major rule. It only applies to your current employer's active plan that you just left. Old plans simply won't work. Let's say you have $500,000 in your active 401. One tee and another $200,000 sitting in an old 401k plan from a previous employer you left years ago. If you retire at 56, you can only withdraw penalty-free from the active plan of the employer you just separated from. That's the only plan covered, folks. The rest ain't touchable. That old 401k from the company you worked for when you were 45? That money is still locked tight until you reach 59 and a half. If you try to withdraw from that old plan, the IRS will hit you with the 10% penalty, with absolutely no exceptions or excuses allowed. So, how do you handle this? You gotta use a smart strategy called a reverse rollover before you officially hand in your resignation letter to HR. 'Cause timing is everything. You take the balances from your old 401k plans and you roll them into your current employer's active 401k plan while you are still working there. That consolidates all your retirement money under the umbrella of your active plan, making the whole balance eligible for the Rule of 55 penalty exemption. But you must do this while you are still actively employed. Once you quit your job, that active plan window closes, and you are stuck with what you have. Now, Let's talk about the third trap, folks. And this one has to do with how your employer designs their specific corporate retirement plan rules. Some rules ain't helpful. Just because the IRS allows the rule of 55 doesn't mean your employer's plan is legally required to offer flexible partial withdrawals to terminated employees. It ain't mandatory. Every employer plan has a legal governing document called the Summary Plan Description, or SPD. And you need to read it very carefully before you quit, 'cause details matter. Some corporate plans have a strict all-or-nothing withdrawal policy for employees who leave. They do not allow you to take out partial distributions, which is frustrating. If your plan is built this way, they will force you to take your entire $700,000 as a single, massive lump sum check. That ain't what you want. That would trigger a massive federal tax bill in a single year, pushing you into the highest income tax brackets instantly and blasting your savings. It isn't pretty. Or they will force you to roll the entire balance over to an IRA, which immediately destroys your Rule of 55 protection and locks the money. That ain't a real choice. So before you make any decisions or turn in your resignation, you must call your HR department and ask for the specific rules on partial distributions. Let's vent for a second, folks. What is the single most annoying piece of corporate jargon your boss ever used in an email? Mine is touch base. Let me know in the comments below. Don't just assume they will let you take out $2,000 a month to pay your bills. Check the actual paperwork first to be safe, 'cause errors are costing money. Now, let's talk about how to plan around these traps and build a safe, reliable strategy for your early retirement years without stress. The key is to create what I call a bridge fund. It's a calculated amount of money left inside your active 401k to cover those gap years, folks. You calculate exactly how much money you need to cover your living expenses from the day you retire until the day you turn 59 and a half. That's a lot of figuring. Let's say you need $50,000 a year and you are retiring at 56. That means you have 3.5 years of gap, so you got a plan. It ain't a game. So you need a total of $175,000 in your bridge fund to get you to the finishing line safely. That ain't a small sum. You leave exactly that amount inside your active 401k plan when you retire, and you don't leave a single penny more than that because you want to roll the rest. Then you can roll the remaining balance of your 401k into a traditional IRA for better investing options, lower costs, and professional management. It's a clean flow. This hybrid approach gives you the best of both worlds, folks. You get penalty-free access to your bridge money through the 401k plan. And you get the investment flexibility of an IRA for the rest of your nest egg that you won't need to touch for several years. But remember, even though the Rule of 55 saves you from the 10% penalty, it simply ain't gonna save you from ordinary income taxes. IRS is always watching. Every single dollar you withdraw from that 401k will be taxed as ordinary income at your current federal and state tax rates. So you still gotta manage your tax brackets very carefully. You don't want to pull out more than you actually need to live each year. A smart strategy is to use bracket fill-in, withdrawing just enough to fill up the lower 12% tax bracket each calendar year. It's smart planning. This keeps your overall tax burden as low as possible while providing the steady cash flow you need to live on during those gap retirement years. We helped Richard look at his options after he made his rollover mistake. It was a tough lesson, but we found a path forward for him. Because he had some cash reserves in a regular brokerage account, we were able to cobble together a bridge strategy for his family. It ain't perfect, but it worked. But it ain't the clean, easy retirement plan he had originally envisioned. It required a lot of tight budgeting and unnecessary financial stress. He told me later, "Earl, I wish I had known about this before I signed those papers. It would have saved me so much sleep and worry. So let's confront the hard truth here, folks. How many of you are currently putting off looking at your retirement paperwork because it feels too overwhelming? Tell me honestly in the comments. It ain't something you should ignore. And that is exactly why we do these videos, folks. To give you the cold, hard facts before you sign the papers, not after it's too late. We want to keep you safe. Let's do a quick, simple recap of the Rule of 55 rules so you can keep them straight in your head going forward in your planning. First, the rule only applies to active employer plans like 401ks. Private IRAs are completely excluded from this penalty-free distribution rule. It ain't for IRAs. Second, it only applies to the plan of the employer you separate from in or after the calendar year you reach age 55. That's the law. Third, check your plan's summary plan description to make sure they allow partial distributions after you leave the company. This is critical, cause of limits. And fourth, build a clear bridge fund to cover your expenses until 59 and a half, leaving only that amount in the 401k plan. All right, jokes aside, 'cause this next part matters more than almost anything else in this video for your family's financial security. If this video helped you understand the Rule of 55 better, please hit that like button so other early retirees can find this warning too. It helps them out. And if you want to get more videos on how to protect your retirement savings, go down to the comments and type the word bridge right now. And tell me, what is the very first thing you will do on day one of your early retirement? Smashing your corporate laptop with a golf club is a valid answer. It ain't a bad plan. I'm Earl. This has been Earl's Money Talk. Take good care of yourself, planning ahead, and I'll see you in the next video. Take care, folks.